Welcome back to the Terra's Dubai Property Report podcast, your monthly deep dive into the world's most exciting real estate market. I'm your host, Chloe Miller, and I'm so glad you're here, perhaps with a cup of coffee, ready to unpack some seriously mind-boggling numbers. I want to start with a figure that should grab your attention. Over AED 51 billion worth of property sold, just in the first 8 months of this year. Now that headline alone tells you the market isn't slowing down. But what it doesn't tell you is the story behind the data. We're not seeing a broad, flat boom this time. We're seeing a highly strategic two-speed market driven by both the quest for ultra-luxury wealth preservation and the hunt for solid, sustainable rental yields. At Terra Real Estate, our job isn't just to sell property. It's to analyze this incredible momentum and give you, our investor, the truth behind the transactions. We want to make sure your capital is working smarter, not just harder. So on today's episode, we're unpacking it all. First, we'll tackle the single biggest shift, the off-plan dominance. We'll explain why over 2/3 of all sales are now happening before construction is even finished, and crucially, how you can vet the risks. Then, we'll shift gears to the high rollers, looking at how the ultra-prime luxury market is completely redefining what exclusivity means in 2025 and why it's become the global safe haven for the world's wealth. And finally, we'll talk about the most common question we get asked. Will the supply surge cool the market? We'll give you our forecast for 2026 and tell you exactly where to position your portfolio right now. Stick with us. This is the only report you need to navigate the Dubai property boom this year. Let's get started with the biggest story in the market, the incredible rise of off-plan. If you've been scrolling through property news or YouTube lately, you've seen the cranes, you've seen the glossy renderings, and you've heard one term repeated endlessly, off-plan. Let's be clear, this isn't just a trend. It's the core engine of the 2025 Dubai market. The numbers speak for themselves. According to the data we track here at Terra, in early 2025, a stunning 69% of all real estate transactions were off-plan. Think about that. For every 3 properties sold in Dubai, 2 were yet to be completed. Why is this happening? Why are investors rushing to commit capital to something that doesn't have a front door yet? It comes down to 3 key drivers. First, the golden goose of payment flexibility. Developers like Emaar, Damac, and particularly Danube are not just selling homes, they're selling an entry strategy. When you see a 1% monthly payment plan, it drastically lowers your barrier to entry. It allows you to secure a prime asset with minimal initial capital, effectively acting as an interest-free loan until completion. It's an investor's dream cash flow structure. Second, appreciation before handover. This is the big one. Because demand is currently so strong and Dubai's population continues to grow, we are consistently seeing properties appreciate during the construction phase. You buy today at AED 1,800 per square foot, and by the time you receive the keys in 3 years, the area's value could have easily climbed 20 to 30%. That's pure, tax-free capital gain without ever having to manage a tenant. Third, the global currency hedge. For international investors, particularly those holding rupees, euros, or pounds, Dubai offers an incredible safe harbor. The AED is pegged to the US dollar, providing stability and security that other global real estate hubs simply cannot match right now. Off-plan is simply the easiest way for that international capital to flow in and get a foothold. So, where is all this money going? The off-plan growth isn't evenly distributed. It's concentrated where the developers are executing their master plans most effectively. We're consistently seeing massive momentum from the usual giants, Emaar, Damac, and Soba, but new models are also emerging. In terms of communities, look to these 4 for where the action is. Jumeirah Village Circle, JVC, dominating off-plan apartment volume thanks to high expected rental yields. We'll talk more about this later, and a slightly more accessible entry point. Business Bay. Its proximity to downtown and the DIFC makes it a perpetual favorite for both residential and commercial off-plan projects, capitalizing on the demand from white-collar professionals. Dubai South, Arjan. These are the long-term play areas. They offer lower current prices, but huge appreciation potential due to massive future infrastructure projects and the expansion of the airport and Expo City area. Now, this is the most critical part of this segment, and frankly, the conversation a lot of people are afraid to have. With this kind of boom, skepticism is healthy. Is off-plan still safe? The short answer is yes, but only if you are diligent. The risks haven't changed: developer reliability, potential completion delays, and market saturation. Back in 2008, when the market crashed, many investors were left with half-built projects and no clear timeline. This is where due diligence matters most. Here at Terra, we have a saying: we don't just look at the brochure, we look at the balance sheet. You need to know the developer's track record. Have they delivered projects in tough times? Escrow safety. Is your payment locked in a secure DLD-regulated account? That is non-negotiable. Payment structure versus construction. Does the payment plan fairly align with the construction milestones? A bad sign is paying 70% before the building is 50% complete. My tip of the week for off-plan investors is simple: calculate your true off-plan ROI. Most people just look at the advertised price. Smart investors look at two things: the capital appreciation factor. How much did the developer's last 3 similar projects appreciate between launch and handover? Use that as your baseline. The cash flow investment. Only count the cash you've actually paid as your investment. If you put 30% down and the property went up 10%, your ROI on cash invested is not 10%. It's much higher. Use this metric to truly assess the performance of the off-plan model. Off-plan will continue to dominate because it efficiently matches developer supply with global capital flow. But remember, the safety is in the selection. Speaking of selection, you might think all this money is going into flexible mid-tier projects, but you'd be wrong. In our next segment, we're going to step inside the world of AED 10 million plus transactions to show you how the ultra-prime luxury market is not just surviving, it's redefining the entire landscape. Stick around. If the last segment was about maximizing your return on cash invested, this next one is about preserving, protecting, and multiplying generational wealth. You might think that with interest rates and global uncertainty, the luxury property market would cool off. But here in Dubai, it's not just defying those trends, it's aggressively redefining the market. In the first quarter of 2025 alone, transactions involving properties valued at AED 10 million or more crossed the 1,300 mark. That is an astonishing volume of high-value capital changing hands. What defines luxury in Dubai right now has fundamentally changed. It's no longer just about Italian marble and crystal chandeliers. Today's luxury buyer is looking for 4 key things: branded residences. They want the service and security of a global hospitality brand: Ritz-Carlton, Bulgari, Armani. This provides a guaranteed standard of quality, service, and crucially, a resilient resale value. Exclusivity and privacy. This drives demand in areas like Emirates Hills and the new exclusive villa communities in Dubai Hills Estate. Waterfront access. This will always be king. Think the established giants like Palm Jumeirah and the new frontiers like Palm Jebel Ali. Smart integration. Seamless, eco-conscious technology that manages everything from climate control to security. Why is this segment booming when other global luxury hubs are seeing stagnation? The answer is the safe haven buyer. This is the ultra-high net worth individual, the HNWI, who is moving not just capital but their lives to Dubai. They are coming from Europe, the GCC, and increasingly, we are seeing a significant flow of capital from Latin American countries, particularly Brazil. For them, the appeal is simple: safety and geopolitical stability. The zero-tax environment, the Golden Visa. The Golden Visa, with its AED 2 million property investment threshold, isn't just a residency permit. It's an exit strategy and a guarantee of a world-class lifestyle for their entire family. This buyer isn't speculating on price cycles. They are securing a future. That mindset provides the bedrock of resilience for Dubai's luxury property prices. If you're thinking of entering this tier, My advice is to look past the initial price tag and focus on the long-term trust factor. As we see it at Terra Real Estate, luxury in Dubai isn't about granite countertops anymore. It's about experience, exclusivity, and, most importantly, trust in the developer and the master plan. We guide our clients to assets that will not only appreciate, but that will retain their premium during any potential market dips. That means vetting not just the view, but the developer's track record in delivering exceptional facilities management for a decade to come. This luxury wave is effectively redefining the top end of the market. But what about everyone else? What about the savvy investor who is focused purely on monthly cash flow? In our next segment, we're going to step away from the palm and into the communities where you can secure that coveted 7% and higher rental yield. We call them the silent performers, and they are the unsung heroes of the current Dubai boom. Stay with me. We've talked about off-plan volume, and we've talked about ultra-luxury value. Now let's talk about pure, consistent, reliable cash flow. Because if you're an investor focused on rental income, if you want your property to perform like a high-grade bond, you need to look past the iconic skyline. You need to look at the mid-market and high-yield segment. We call them the silent performers. Globally, getting a stable rental yield of over 4% is considered excellent. Here in Dubai, savvy investors are securing returns closer to 7.25% and sometimes even higher. This is the figure that is drawing the global investment community like a magnet. Why is the yield so high in these areas? Simple. Demand is enormous, and the entry prices are relatively accessible. These communities cater to the massive influx of middle to high income professionals who are moving to Dubai for work and lifestyle, but don't want the cost or commitment of a downtown apartment. The three current leaders for yield are Jumeirah Village Circle, JVC, the consistent leader, offering excellent infrastructure for families and young professionals. Its high volume of new quality buildings keeps tenants happy and rental demand strong. Dubai Investment Park, DIP, strategic location, catering to professionals working in the surrounding industrial and business hubs. It's an incredibly stable, demand-driven market. International City. This one has the lowest barrier to entry and can often provide the highest gross yield purely due to low property purchase prices and consistent demand from budget-conscious expats. The people driving this segment aren't the traditional Gulf investors. They are the new investor profile, younger buyers, remote entrepreneurs, and digital nomads who are using Dubai as a home base. They are looking for assets that require lower down payments and start generating income almost immediately upon handover. This is why the affordable off-plan models are so popular here. We see developers like Danube pioneering their 1% monthly plans and others like Samana offering innovative payment options. They are targeting the yield-focused investor who wants to maximize the return on every dirham of paid capital. The key to success in this segment is sustainable ROI versus risk. You need to ensure the rental yield you project is achievable long-term, which means prioritizing properties near new infrastructure, metro links, and established community amenities. Let's do a quick yield check to show you the difference between these two markets, using the same initial investment capital. Let's say AED 2 million, Property A, the luxury performer, a one-bedroom apartment in a prime downtown tower. Purchase price, AED 2 million, expected annual rent, AED 120,000, gross yield 6.0%. Your primary gain is the long-term capital appreciation. Property B, the silent performer, 2 studio apartments in JVC or DIP. Total purchase price, AED 2 million. Expected annual rent, AED 150,000, AED 75K each. Gross yield, 7.5%. Your primary gain is the immediate high cash flow and diversification across 2 units. Both are smart investments, but they achieve completely different financial goals. One is betting on the value of a single trophy. The other is maximizing monthly income. It's crucial to know which path you're on. The mid-market is a powerhouse of cash flow and an essential component of the Dubai investment story. But with all this activity, the off-plan rush, the luxury migration, and the high-yield performers, it all leads to one major concern that we are hearing from every corner of the market: supply. Is Dubai about to build itself into trouble? In our next segment, we're tackling the big question: will the supply surge cool the market? You might be surprised by the answer. So, we've established that demand, from both luxury migrants and high-yield hunters, is massive. But if you talk to any long-term observer of the Dubai market, their internal alarm bells start ringing when they look at the construction pipeline. Let's talk about what everyone is worried about: supply. The numbers are huge, and you need to know them. Over 70,000 new units are scheduled for handover in 2025, with an even bigger wave of over 133,000 more expected to hit the market by the end of 2026. In any other global city, this volume of new inventory would trigger a sharp, immediate cooling of the market, potentially leading to a price crash. So, is Dubai headed for an oversupply-driven correction? The answer, as always in this city, is nuanced. We at Terra are forecasting a two-speed correction based on location and quality. The mid-market vulnerability. In areas with massive new off-plan deliveries, particularly those with less differentiated quality, we could see a 10 to 15% price correction. Why? As thousands of new apartments are handed over in quick succession, investors who bought purely on hype might scramble to sell or rent, flooding the market and pressuring prices. This is the classic boom and bust cycle everyone fears. The premium resilience. The luxury and ultra-prime segments are expected to remain remarkably resilient. The unique, high-quality assets in master-planned, established areas like Palm Jumeirah or Dubai Hills Estate are not competing with the generic supply. They are trophy assets purchased by cash-rich HNWIs who are not as sensitive to temporary market fluctuations. Demand at the very top is still outpacing the supply of truly exclusive products. Why are we confident that the market won't collapse? Because we have to remember the powerful macro counter-context: Dubai's relentless population growth and its infrastructure boom. The government's strategic planning, the Dubai 2040 Urban Master Plan, is the backbone here. They are aggressively pushing for massive population growth, and they are backing it up with world-class infrastructure, new metro lines, and economic diversification. The market is effectively betting that the number of people moving here will keep pace with the number of units built. So, what does this mean for you, the savvy investor? It means the game has changed from quantity to quality. Your investment thesis for 2025 and 2026 must be built around a flight to quality. Location matters. More. Choose communities where the infrastructure is already established or guaranteed by major government development. Developer reputation is everything. In a time of high supply, the developer who delivers on time and delivers quality will see their assets hold value. Don't compromise. Community is key. Focus on master-planned environments that offer amenities, green space, and a distinct lifestyle, like those driving the ESG trend we'll talk about shortly. The supply surge is a reality, but it's not a panic button. It's an evolutionary filter that will expose weak projects and reward those who focus on quality and strategic location. And speaking of that strategic location and quality, one of the biggest reasons people are even moving here, which drives all this market activity, is the government's investor-friendly policies. In our next segment, we're going to focus entirely on the golden visa and the massive global buyer wave that is turning Dubai into the world's ultimate immigration destination. If I could point to one government policy that is single-handedly fueling both the off-plan boom and the luxury migration, it wouldn't be a tax break or a construction incentive. It would be the golden visa. In our previous segments, we talked about global capital flow. But this flow isn't just money chasing a return. It's people chasing a better life and greater stability. People aren't just buying a property in Dubai. They're buying a ticket to residency, and that makes all the difference. The golden visa acts as a massive anchor for foreign investment. It gives high net worth individuals and skilled professionals the confidence they need to commit long-term capital to the UAE. Here are the key facts you need to know about the property route. The threshold. The current investment threshold is an easily accessible AED 2 million worth of property. The benefit. It grants you a renewable, long-term residency visa up to 10 years. The confidence. Critically, this visa extends to your spouse, children, and key domestic staff. For a global family, it provides security and an immediate path to the world-class education and healthcare Dubai offers. This is why we see a significant shift in buyer behavior. They are no longer buying purely for short-term flipping. They are buying with a long-term perspective because their future, their family's future, is now tied to this property. The Golden Visa, combined with the safety and tax-free returns, has triggered a massive demographic shift. The influx of new residents is diversifying the investor pool far beyond its historical core. Europeans. We are seeing a continued wave of high-income Europeans, especially from the UK post-Brexit, seeking a low-tax environment and a better quality of life. GCC investors, our neighbors in the Gulf Cooperation Council, continue to view Dubai as the most reliable, high-growth investment destination in the region. Latin America. This is the exciting new frontier. We've seen significant capital flow from countries like Brazil and Mexico. For these investors, Dubai offers a level of political and economic stability they simply can't find at home, making it the ultimate safe haven destination. Dubai isn't just a financial hub. It's rapidly becoming the world's most desired immigration destination for the wealthy and the talented. It has the tax advantages of a financial center, the safety of a closed state, and the lifestyle of a global resort city. It truly feels like the new Monaco for a wider, more globally diverse range of HNWIs. This global buyer wave is the single greatest reason why the supply surge, which we discussed in the last segment, is not a cause for panic. The demand is constantly being replenished by new people, new businesses, and new money arriving every day. But while the buyer wave is here now, we need to look even further ahead. In our final major segment, we are going to look at what the future of property actually looks like. We'll dive into sustainability, AI, and the groundbreaking master plans that are set to create the next generation of Dubai downtowns. So far, we've covered the present, the off-plan boom, the luxury migration, and the high-yield performers. Now let's look forward, because what Dubai is building today will define global real estate for the next 2 decades. The future of property isn't just about taller buildings, it's about smarter buildings, greener communities, and fundamentally rethinking urban centers. Globally, ESG, environmental, social, and governance, is not a buzzword anymore. It's a prerequisite for serious investors. Dubai is embracing this wholeheartedly, driven by the government's aggressive net zero by 2050 commitment. For investors, this shift translates into tangible value. Cost savings, features like smart cooling systems, solar integration, and water recycling reduce utility costs significantly, which directly boosts your net rental yield. Resale premium. Buyers and tenants are actively seeking homes with green certifications. In a supply-heavy market, a green home holds a distinct, demonstrable competitive edge. We see this played out beautifully in master-planned communities like Tilal Al Ghaf and Expo Valley. They are built around lagoons and vast green spaces, proving that luxury and sustainability can go hand in hand. This is no longer a niche market. It is the new standard. Beyond the physical structure, technology is transforming the transaction itself. AI and digital tools are making the Dubai market more transparent and efficient than ever. Digital transactions, blockchain technology, and digital land registries are streamlining sales, reducing paperwork, and improving security, a crucial factor for international buyers. AI property matching. Algorithms are now being used to match investor goals, e.g., high capital appreciation with minimal cash down, with specific off-plan launches faster than any human agent could. Virtual tours and property management. You can now manage a full portfolio, conduct inspections, and even close a sale from the other side of the world, all thanks to advanced digital platforms. The introduction of this high-level tech reduces friction, minimizes risk, and increases the speed of the entire investment cycle. This is a massive win for the foreign investor. Finally, let's talk about the map. Dubai is fundamentally changing its urban footprint, creating new economic and residential centers that will rival the success of downtown Dubai and the marina. As investors, you need to look at these next downtowns for truly exponential long-term growth. Dubai Creek Harbor. We've been talking about this for a while, and its time is now. Positioned as the genuine future downtown, it combines stunning waterfront views with massive commercial potential. The completion of the Creek Tower and the surrounding master plan guarantees a long runway for appreciation. Palm Jebel Ali. This is the new frontier of ultra-luxury. Positioned as a dramatic expansion of Dubai's iconic coastline, it promises to redefine waterfront living and will attract a new wave of UHNWIs looking for true novelty and exclusivity. The master plan hubs. Keep an eye on the integrated developments around Dubai South and Expo City. These aren't just residential areas, they are strategic economic hubs, linking aviation, logistics, and innovation, guaranteeing long-term rental and commercial demand. The takeaway here is that Dubai isn't just following global trends in sustainability and tech. It's leading them. Investors who recognize this, who prioritize ESG and smart infrastructure today, are the ones who will capture the premium tomorrow. At Terra, we're not just following the market, we're reading what's next. We ensure that every off-plan project we recommend isn't just affordable, but is also future-proofed with smart green technology. That brings us to the end of our deep dive. Before we wrap up, I want to share a few final thoughts on how to pull all these pieces together, the high yield, the luxury, the supply fear, and the future tech, into a single, cohesive, and smart investment strategy. It's time for the Terra perspective. We've covered a lot of ground today. We started with the sheer power of the 69% off-plan boom. We journeyed into the rarefied air of the AED 10 million plus luxury segment, and we looked ahead at the supply surge and the inevitable rise of smart, green communities. Now, it's time to bring it all back to your money. How do you take these market trends and turn them into a secure, smarter investment strategy for the next 18 months? At Terra Real Estate, our philosophy is simple: integrity, analysis, and transparency. We've seen the highs and the lows of the Dubai property cycle. Smart investors know it's not about chasing the loudest trend, it's about understanding the current market structure and positioning yourself ahead of the curve. Here are 3 key pieces of guidance for every buyer entering the Dubai market in late 2025. 1. Execute the 2-speed strategy. Forget the idea of a single monolithic Dubai market. You must decide whether you are chasing yield or appreciation. If you need cash flow and high returns from day one, your focus must be on the mid-market leaders like JVC, DIP, and specific off-plan payment plans that minimize initial capital outlay. Your risk mitigation is done by diversifying across multiple, smaller units. If your goal is wealth preservation, capital growth, and the golden visa, your focus must be on prime, branded residences, and master-planned villas. Your risk mitigation is done by focusing on the scarcity of the asset, waterfront, branded, or master community exclusivity. Don't try to do both with one asset. Define your goal and then choose your segment. 2. Prioritize developer track record over price. With the massive supply surge coming, the market is quickly going to separate the wheat from the chaff. The biggest risk today is not the macroeconomy. It's being stuck with a delayed, lower-quality project when the market has moved on. When assessing an off-plan deal, always ask, will this asset be desirable in 3 years when it's handed over? This means looking beyond the discount and verifying the developer's completion rate on their last 5 projects, their financial stability and commitment to the DLD's escrow standards, the project's inclusion of ESG-aligned features, because a smart, sustainable home will have better resale value than a cheap, generic apartment. In this market, quality is the new liquidity. 3. Think long-term. Bet on the government's vision. The fundamental difference between Dubai and every other speculative property market is that in Dubai, you are betting on a massive, unified, state-backed vision for growth. The confidence is in the Dubai 2040 plan and the commitment to attracting global talent. When you invest here, think 5, 7, or 10 years out. Are you near a future metro line? Are you near a new airport or a commercial district? Assets tied directly to this infrastructure and population growth narrative are the ones that will ride out any short-term supply fluctuations. Dubai continues to evolve, and for investors who stay informed, the opportunities are still incredible. You just need the right data and the right partner to help you navigate the complexity. Here at Terra Real Estate, we combine that high-level market analysis with transparent, client-first advice. Whether you're ready to dive into the off-plan pool or you're vetting your next ultra-prime safe haven asset, we have the team and the tools to support your decisions. If you'd like to dive deeper into any of the communities or developers we mentioned today, from the 7% yielders in JVC to the new exclusivity of Palm Jebel Ali, visit us at terradubai.com. We offer personalized portfolio reviews designed specifically to match your financial goals with the current market realities. You can find this and all others necessary links in the description of the show. Thank you so much for tuning in to the Terra's Dubai Property Report. Be sure to subscribe for next episode. Until then, I'm Chloe Miller, and happy investing.